All right. Hello again, everybody. This is Mike Rixey. I am the lead options instructor for NetPicks, and this is our options midweek update. What I wanted to do here today is to walk you through some of our thoughts on the overall market and then dive into some individual trades that we're looking at here for the next few days. It has definitely been an interesting start to the week, very news driven yet again. We've talked about that quite a bit the last few weeks. We just continue to see this market 100% glued on what's happening with the stimulus negotiations. Is there going to be another stimulus plan released? Is there not? I mean, we've had rumors both ways the last 24 hours. We had President Trump issue a tweet yesterday afternoon that caused a pretty big sell-off market-wide. It lasted a couple of hours, and then we spent most of the overnight. The futures markets rallied higher, and we've seen a continued higher for just about the entire session today. The rally today is on hopes of some type of stimulus being passed here over the next few days. We'll see if that happens or not. Markets are certainly pricing in a lot of good news here. And the tricky part about the last few days is because the market is so news driven, you just have no idea when those headlines are going to hit or when that Trump tweet is going to be released, and it causes chaos for a brief moment in time. These moves around the headlines are big enough to where if you're not careful, orders can get filled, stop orders can get hit, and it becomes very challenging and very easy to get whipped around. I bring this up because we've talked about it the last few weeks, what we've been doing on our side to adjust to this type of environment. It's not something that's scaring me to the sidelines, not at all. We're going to stay active. We just want to be, number one, as diversified as we possibly can. With options, we can do that a couple of different ways. We can mix up the markets that we're trading. We can mix up the option strategies that we're using. We can mix up our expiration cycles that we're using. There's a lot of ways that we can adjust our approach to current conditions. We also want to make sure that we're controlling our size. Now is not the time to just go all in, right? Trade small size right now. That way, if you do get caught on the wrong side of a news-driven move, it's not going to wipe out an account. It's not going to prevent you from taking the next trade. If you can stack the deck in your favor over time by building your sample set of trades, you will absolutely make money. Where people get caught, especially retail traders that are just starting out, they take that approach of, let me just hit it big once or twice, because if I do that, it changes the whole ball game for me. Well, that might be true. It just comes with massive amounts of risk. And if you hit a loser with a huge position size, it can be painful in a hurry. In this market, between now and the election, you want to be cautious. Play it safe. Take a larger number of small positions and you will be much better off. I know some of you that have logged in for these sessions here in the last number of months, you've heard me talk about this over and over again because I continue to see people trading way too large for their account. It's the number one issue that holds people back. So just wanted to talk through that because it just continues to come up in discussions with traders on a regular basis on our side. Let's talk specifically about some technical levels. We can't control the news cycle, but what we can do is react accordingly due to price action that we're seeing. We always like to start out with a daily chart of SPY. You can see here that the last couple of weeks, we've been on a nice push to the upside. This market feels like it wants to make another run at the highs. If we get another round of stimulus, who knows? I mean, we could see a pretty quick pop to the upside. We're also heading into earnings season between now and middle, I'd say early to middle November. The earnings season going to be very active. A lot of the big tech names towards the end of the month will have their quarterly earnings that come out. That can cause some pretty big moves in the overall market. The reason I bring all this up, the catalysts are there for volatility. We want to be open to both directions because no one knows what the market's going to do next. But from the technical perspective, in the near term, I'm looking for a potential continuation move to the upside. The next area of resistance that I'm looking at is right around 342.50. That's in the near term. That could very well be hit in the next 24 hours or so. Above that level, we've got a nice little air pocket here up to 350. So we could see a nice push to the upside that could potentially happen if we get that stimulus news or that stimulus bill to be passed. We'll see if that takes place or not. On the downside, if we get some selling over the next few days, we've got this whole cluster of moving averages below us. We broke up through those levels on the upside. Those now all become support levels on the downside. The first area that I'd be looking at on the downside, if we do get any type of selling, 336.50 is an area that I'd want to watch on a move to the downside. The volume, 37 million shares have traded here today with 20 minutes to go in the session. The volume continues to be very light on the upside. On these rallies that we've had the last few weeks, you can see it down at the bottom. In a good number of these cases, the volume has been lighter. There's not a ton of conviction on the upside, but we've seen it the last few years where when volume dries up, we tend to favor the upside, and we're getting that situation again here this week. So want to watch volume closely. If we do get a break in either direction, we want to see volume confirm that move. If we take a look at the internals here today, how broad-based is this move? I mean, you take a look at the index products, you have the Dow up 550, you've got the S&P up 60, the NASDAQ's up 200. Those look at great numbers, right? Well, the internals are pretty darn strong as well. The volume ratio on both the New York Stock Exchange and the NASDAQ, 5-to-1 positive on both of those. So the volume definitely favoring the upside here. The advanced decline line in the upper right-hand corner, we're currently seeing at plus 1,800 on the NASDAQ. Pretty across the board buying. And anytime that we get a move to the upside, we want to see the advanced decline line at plus 1,000 at a minimum. We're at plus 1,800 on the NASDAQ and plus 1,450 on the New York Stock Exchange. That indicates pretty across the board buying. There's a lot of sector participation here. There's very few weak areas in this market today, which, I mentioned volume a little bit lighter, not a good thing, but the internals that I'm seeing here, what volume we do have, definitely favoring the upside, and the broad-based participation, also something to like if you're bullish here. It's been a pretty quiet day as far as movement goes. It's been a one-way directional move higher. I mean, you can see it on the 5-minute chart of SPY. It's just been that slow, methodical grind to the upside. We've had very few sell programs at all today. In fact, we haven't had any sell programs. It's just been that slow move to the upside. So cautiously bullish here going into the next few days. But again, a lot of that depends on what happens with the stimulus bill, whether it passes or not, and what it looks like here over the next few days. Let's jump on over to some of the individual charts that I like to track. The daily chart that I just took a look at on SPY, that's not a chart that I'm looking for entry and exit points off of. It's just a chart that I use to gauge overall market sentiment, whether I want to be bullish, bearish, or neutral. Do I want to trade more weekly or monthly options? That daily chart can help guide me. And what I'm seeing there on the daily chart has me more focused on a cautiously bullish outlook. Right, I'm looking to lean bullish here, but in doing so, I'm looking to use smaller position sizes. I've been using more longer-term monthly options. I haven't been doing a ton with the weeklies. And then I've been using a lot of vertical spreads just to be more cautious on the upside given the headline risk that is there in the market. We talked about this chart here end of last week when we connected for our weekly recap. We mentioned that we had a chart there that had triggered in on the long side. We were cautiously bullish, and that outlook has continued to play out. We continue to see this long trade work for us. It's nothing earth-shattering as far as profits go, not breaking any profit records, but we're certainly seeing a profitable trade so far. And if we do continue to get that move higher, like we've been talking about so far, that one will continue to move towards our full target, looking for a 100% return on the bullish position that we do have on SPY. So looking good there. The NASDAQ ETF QQQ, very similar looking charts in that, the index products, they continue to favor the upside. And as soon as TradeStation will load up the chart, you'll see the long setup that we're in right here. Why are these long setups? Our trend strength indicator down at the bottom went from red to blue. We saw price action move above our moving averages up top. Those are the 8 and the 50 period exponential moving averages. Those are the lines that I like to use for confirmation on a trade. And those blue plus signs there, those indicate our entry points. So we are in a long setup here on the NASDAQ. Very typical price action going into earnings season. A lot of times when you go into earnings season, the previous couple weeks before the earnings really kick in, you'll typically see more choppy, indecisive price action. Not saying that's going to be the case here over the next couple of weeks, but we're certainly seeing signs of that. A lot of the tech stocks have had great movement here the last quarter. A lot of good news already being priced in. So we'll see how much some of these names have left in the tank going into their earnings here towards the end of the month. But NASDAQ, the NASDAQ ETF certainly in a long setup in a tiny profit here so far. IWM, the Russell 2000 ETF. certainly has been lagging behind on many of these moves. On many of the moves to the upside, the small caps have been lagging behind, and at least here the last couple of weeks, they have been trying to play catch up. You can see this impressive move to the upside. Our trend strength indicator flipped from red to blue. We saw price action confirm up above our moving averages. This trade triggered in back on October 2. So we've been in this position for about 5 days now, working really, really well. And really a pretty explosive move there on IWM, approaching some target levels here, overbought in the near term. So what's interesting is that essentially the last week or so, IWM has taken the leadership role from the NASDAQ. The NASDAQ has not had to be overly impressive on the upside because the Russell's been doing a lot of the hard lifting, and we'll see if that continues over the next couple of days. So not on any of these index products, not looking for any new setups at this point, not looking to chase this move higher. If you're not already long, I don't think now is the time to initiate bullish positions on the index products. I'd be a little bit more cautious there. Potentially sell some spreads. I'd be okay with that, given that we're overbought in the near term on IWM, but not looking for any new long call or long put trades there for the time being. Apple. We do have earnings out towards the end of the month, so we have to be cautious there. A lot of times, again, like I mentioned, you can see choppy conditions kick in. I'm okay taking some trades between now and earnings. That's okay. I just don't want to hold. I'm not planning on holding any positions through Apple earnings. I'd rather stay flat going into those earnings numbers. Apple is currently in a long setup. A lot of choppiness has kicked in here. We know that out of this choppiness will come a good move. It's the coiled spring pattern that we've talked about previously. Apple does not like to stay quiet for very long. It's typically a very active name back and forth. And when you start to see chop like this, like we have over the past week to week and a half, a lot of times we'll see price action break out of that sideways chop. Unfortunately, you just don't know whether it's going to break higher or lower. Right? So time will tell, obviously, but if we can start to break either this 117.50 level on the upside or on the downside, we're looking at right around 112. If either of those levels break, it should lead to a pretty nice move. Right now, given that the system is in a long setup, I would like to see the same break higher. Again, if you get any type of stimulus news to come out and this overall market decides to break higher, Apple will most likely lead the charge. So cautiously bullish here on Apple. Facebook. Given the strength in the overall market today, Facebook has actually lagged behind. Go ahead and pop up the chart here and you can see it's only up 30 cents. For a good portion of today, it was actually lower on the session. So we'll see if that means anything. If we do get any type of selling over the next few days, we'll see if Facebook decides to give it up a little bit on the downside. We do have earnings out on Facebook on October 29th. So we got a little bit of a window here. We've got about 22 days or so to sneak in another trade. So we'll see. I mean, we do have a short that has set up here. Technically, it has triggered in. It is a short setup because our trend strength indicator went from blue to red down here at the bottom, indicating bearish sentiment taking over. Price action closed below the 8 and the 50 EMAs up top. And that gave us our blue plus sign. So we did get a short setup that triggered in here. 257.32 is the entry. And the reason I wanted to bring this one up, I've talked so far about being cautiously bullish on many of these products. I don't want to be 100% bullish. I actually would welcome some bearish trades here on some of these products like a Facebook because I want to diversify. Anything can happen. If we get some bad headlines to hit, in this market, we saw it yesterday afternoon, this market can move lower in a hurry. And I want to have at least some bearish exposure on just in case we do get that move lower. So Facebook, cautiously bearish there. I'm continuing to trade a lot of monthly options, which I'll show you here in just a second. In fact, let me bring up my platform. I continue to look at a lot of November monthly options, the ones with 44 days left to expiration. I've had some questions come in on that. Why am I looking to go out 44 days? If I'm only looking to be into a position for 3 to 10 days, why go out 44 days to expiration? The reason I'm going out to November, number one, if I go out 44 days, the time decay is not as big of an issue. It's there, but it's not as big of an impact as the weeklies with only 10 to 20 days left to expiration. by limiting that time decay, that's important because we have seen a lot of choppiness in many of these markets. We talked about Apple and Facebook just kind of being in those sideways patterns. QQQ just being in a sideways pattern the last week. This market feels like it's ready to make a big move, but if it doesn't, I don't want that time decay to crush my positions. I would rather pay up, even though the November options are more expensive, it's going to give me a higher quality position with less time decay. Not to mention the monthly options typically have better liquidity, which makes it easier to get fills on trades. So if we open up the Facebook options, with that long put position that we were talking a few moments ago, with that bearish setup on the chart, I wanted to come over here, take a look. Ideally, I would like to get slightly in the money. I was looking at the 265 puts here out in November. They have plenty of liquidity, 7,000 contracts of open interest, almost 100 contracts have traded today. So we've got great liquidity there. If we take a look at the price, though, we're talking about $2,000 a contract, right? They're trading for $20 a contract here. They're expensive. They're rich. They're expensive because it's not only is it a $260 stock, but these markets are already pricing in earnings. There's all that earnings uncertainty that is out there, and that's being priced into the option markets. That's causing option prices to be more expensive. So you are definitely paying up for those options. But again, you're getting a higher quality position just given the time decay aspect. So I like the 265 puts there on Facebook. Let's go over, take a look at Costco and Disney. Costco has had a really nice push to the upside. It's been phenomenal, really. I mean, you take a look and you wouldn't know that there's economic uncertainty out there, right? You wouldn't know that unemployment is very, very elevated because look at this chart. I mean, it just continues to plow its way higher. And we just now saw some yellow bars plot on our pulse histogram down towards the bottom of the chart. When those bars start plotting yellow, it indicates that price action is between a 1 and a 2 standard deviation channel move on the upside. In other words, price is overbought. It does not mean Costco can't move higher. It just means it's not statistically probable. Odds favor, out of this type of a pattern, odds favor either a sideways move or even a reversal to the downside. What that has me looking for here is to sell a call spread. Selling a call spread is a neutral to bearish position. Ideally, we would love to see the stock move lower. If it does, we're going to make money faster. But if it doesn't, if we just chop sideways and we start to consolidate here, we can still make money from that sideways move. So we give ourselves multiple angles or multiple ways of making money on the trade. So let's jump over to the trade page and walk you through a trade that we put on with our students here earlier today. So with Costco, we went to the November options. I went to the out of the money call options and I went to the 375 calls. They have roughly a 66% chance of closing out of the money. I right clicked on the 375 calls. I went to sell and I selected vertical. We want to sell a vertical spread here. It popped up an order down at the bottom where I am selling the 375 call to open up the position. And then at the same time, I'm buying the 380 call to open. We're trading two different options at the same time. We would be collecting $1.60, $160 per spread, and we're risking $340 per spread. We're right around risk 2 to make 1. I'm okay with that ratio because we've got 5 ways of making money on the position. I make money if the stock moves up, down, or sideways, as long as price stays below 376.60. We make money. That number right there, the 376.60 number, that is calculated by taking my 375 call that I'm selling. We're adding on the $1.60 that we're collecting to put the spread on. That gives me the break even. That's the price that I need Costco to stay below. If it does, we can make money. I also make money from time decay, adding up every day that passes, that helps me, and from volatility decreasing. So I've got 5 ways of making money on the position. All right. So that is one of the trades that we were looking at this afternoon. All right, cautiously, it's a neutral to bearish position on Costco over the next 44 days. If we get filled at $1.60, how do we manage the position? I'd be looking to close it out when I can keep between 50 and 75% of my max profit. The max profit is the $1.60 that I collect to put the trade on. So if I can buy it back for between 40 and 80 cents, that's what I'd be looking to do. All right, Disney. No surprise here that Disney has certainly been lagging behind. Makes sense with what's happening in the overall economy. And if we take a look at this 195-minute chart, you will now see that our pulse indicator is plotting yellow, but now on the downside, indicating that we are oversold in the near term. Just like Costco, it doesn't mean that that Disney can't continue to move lower. It just means it's not statistically probable. Odds either favor a sideways consolidation, which we're already starting to see here the last couple of days. We've started to settle into a little bit of a sideways move there, or even a bounce to the upside. All right, so this is a chart where I'd be potentially looking at putting on a neutral to bullish position, cautiously leaning to the bullish side on Disney. Again, I'm trying to mix it up. I want to have bullish and bearish positions on here. I don't want to lean completely to one side because anything can happen. We could get a headline out here after the close today that causes chaos again. You just never know, right? So I want to be as diversified as I possibly can be. So on Disney, what we were looking at doing here earlier today is to sell an out-of-the-money put spread. Okay, so now with this trade, we're actually going to look at using the October 30 weekly options. So I'm going to go ahead and open those up here. And we're going to go ahead, we're going to take a look at selling an out-of-the-money put spread where I'm selling the 121 put and buying the 119 put at the same time. So I'd be right-clicking on the 121 put, go to sell, and go to vertical. That's going to pop up an order down at the bottom. And I've already got it loaded up here, where I am selling to open the 121 put and then buying to open the 119 put at the same time. It gives me a fully risk-defined trade. If I get filled at 69 cents here, and actually let me change this quantity to 1. The 69 cents or the $69 per spread that we're collecting to put the trade on, that's the most I can make on the position. My risk would be $131, or right around risk 2 to make 1. I'm okay with that ratio because we have 5 ways of making money on the position. I make money if Disney moves up, down, or sideways. As long as it stays above 120.31, we can make money. We also make money from time decay adding up and from volatility decreasing. With price at 123, we've got almost $3 that we can be dead wrong. Disney can continue to move to the downside by almost $3 and we're still okay. We don't expect that to happen because, as we just mentioned, Disney's already oversold. We're actually expecting a potential move to the upside. So if we get filled at 69 cents here, the goal here would be to buy it back when I can keep between 50 and 75% of my max profit. So if I can buy this thing back for anywhere from 17 to 35 cents or so, anywhere inside of that range would be an acceptable profit target. So that's what I'm looking at here on Disney. So the credit spreads, I love them in this market because they are definitely more forgiving type trades, right? They're going to give us more ways of making money, and I don't need to be perfectly right on direction. And in this market where anything can happen on any type of headline that comes out, this is just one way to lean more conservative. And we'll certainly see better movement here in the weeks to come as price action starts to break out of some of these sideways patterns. We'll certainly see better movement. And if once that happens, we'll definitely shift our focus to more of the long calls, long puts again. But for the time being, I continue to look at a lot of vertical spreads. So we'll see what happens. Again, market overall, definitely leaning cautiously bullish here. I think you have to be, given what we've seen the last week or so in price. But we'll see what happens over the next few days. I'll be back on Friday. I will try to do one of these live so you guys can join us live and ask any questions in real time Friday midday as we wrap up the week. So if you have any questions between now and then, feel free to post a comment here on the video or send me an email directly. Mike@netpicks.com is the email address. So enjoy your afternoon, everybody. I'll be back with you here on Friday as we wrap up the week.